Hello, everybody. My name is MJ the Tutor, and you are listening to Accounting Makes Sense, an MJ the Tutor podcast. This podcast focuses on helping accounting students all over the world by offering a quick warm-up on various accounting and business topics that hopefully leads to the generation of bigger discussions and conversation. So for today, I thought I'd do something different and start a series of episodes talking a little bit more about accounting standards, since it seems to be a topic that a lot of students are interested in, especially when they're taking a CIMA case study exam. I think for objective tests, this might not be so much of an issue, since it is a technical topic, and if you know the requirements or criteria of a particular standard, the answer is clear-cut and straightforward. However, it is a little more tricky when you are using this technical knowledge and applying it to a situation or scenario. In fact, in the recent examiner's report that was issued after the November 2024 exam session, examiners note that, and I quote, Level 1 answers often did little more than summarize the requirements of one or more potentially relevant accounting standards. Such answers often suggested a detailed knowledge of the standard, but offered little application of the standard's requirements to the task in hand. It is rarely sufficient to quote, say, a formal definition set out by an accounting standard if little or no attempt is made to relate that definition to the issues raised in the scenario. Candidates still appear to be weak in terms of their understanding of the F pillar. I think for now, I'd like to focus on group accounts for this episode. For those who want to know where this fits in the bigger scheme of things, this is a management level topic, so it normally appears on the MCS level. Maybe I'll do about 3 to 5 for group accounts or related topics, and then I'll see how I go along. I might decide to do the other accounting standards and just kind of break it down into digestible, bite-sized information. For today, though, as mentioned, I'd like us to cover an overall view of consolidating group accounts. It's one of those areas that can feel overwhelming at first, but once you understand the logic behind it, everything should start to click. So, our start will be to cover why group consolidation is necessary. We will look at the step-by-step process of consolidation. We'll touch on common adjustments that happen, including goodwill and non-controlling interests. And we will end the discussion with some of the biggest pitfalls that students face when learning about this topic. So let's start. Why do we consolidate? At its core, consolidation is about presenting a group of companies as if they were a single entity. So, understand what I just said there. It's a group of companies, be it 2 to how many, and putting all their numbers together and showing only one set of financial statements. This ensures that the financial statements provides a clear and accurate picture to the investors, to the regulators, and to other stakeholders. Let's take for an example, suppose we have a parent company, which we'll call a parent company, that owns 80% of a subsidiary, the sub-company, and on their own, each company prepares its own financial statements. So you'll have the parent company preparing their own financial statement, and you have the sub-company or subsidiary preparing their own. Now, we have to add them together because we know that there's a relationship between the two. If we were just to add them up, right, there would be some double counting of some elements like intragroup sales and profits. To avoid misleading financial reporting, we need to consolidate the two financial statements. How do we do this? We add up assets, liabilities, income, and expenses for both companies. We eliminate any kind of intragroup transactions to prevent that double counting issue. And the third, we recognize any non-controlling interests for the part of the subsidiary that is not owned by the parent company. So, let's try this in practice. The consolidation process follows a structured approach. Let's go through it step by step. Number 1, we start with the individual financial statements of the parent and the subsidiary. Second, we look at combining all the assets and liabilities line by line. Third step, we eliminate the parent's investment in the subsidiary against the subsidiary's share capital and reserves. Number 4, we look at calculating goodwill. This is done by taking the consideration paid less the difference between fair value of assets acquired and the liabilities assumed. If the goodwill is negative, we recognize this as a bargain purchase gain. Number 5, account for non-controlling interest. In our example, the parent owns less than 100%. We calculate the proportion of net assets belonging to minority shareholders, which in this case is 20%. Number 6, we eliminate intragroup transactions. This could include sales between the parent and the subsidiary company, the intragroup balances, any kinds of loans, receivables, or payables, and we also look at eliminating unrealized profits in inventory or non-current assets. Following these steps, we ensure that the consolidated statements reflect only external transactions and do not include any internal ones. Now let's touch on common adjustments in consolidation. Let's break this down to some of the biggest adjustments that students struggle with. Number 1, goodwill impairment. We know that goodwill is one of those adjustments that we have to do, especially when it comes to parent and subsidiary, or there's group accounts, right? So goodwill isn't really amortized. It's tested annually for impairment. If it is impaired, we actually make an adjustment where we reflect the loss where it reduces the profits of our business. Imagine your parent company that's acquired 80% of your subsidiary for $500,000. The fair value of the subsidiary's net assets is $400,000. To get to goodwill, you take your $500,000, subtract 80% of the $400,000, which gives you an amount of $180,000. So the $180,000, that's your goodwill. So the second adjustment that we have to account for is non-controlling interest. This represents the portion of a subsidiary that is owned by external shareholders or your minority shareholders. It's shown separately in equity and the income statement. Now, in our example, it is the 20% that is owned by others in the subsidiary. So that just means that non-controlling interest holds 20% of the subsidiary's net assets, profits, and they're all recorded in equity. You can show that in there. So the third adjustment is intragroup transactions. This can cover any sales, expenses, or balances between group entities that has to be eliminated. So as an example, perhaps, your parent company is selling goods to your subsidiary. So that sale needs to be eliminated from the parent company's books, and the purchase on the other side of basically on the subsidiary's book has to be eliminated with that amount. We have to remove these lines so that they're not double counted in the books. This can also cover your dividends paid by the subsidiary to the parent. This also needs to be canceled during consolidation. Any intragroup loans must be eliminated so that the group doesn't appear to be, borrowing and lending in itself or to itself. By understanding these adjustments, you'll avoid the common pitfalls of consolidation. You may want more details as to what and why for some of these adjustments. I'll try and cover those in separate episodes so that this specific episode doesn't feel so tedious and burdensome with too much information about different aspects of consolidation. For now, I just want to keep this conversation about consolidation as an overview. So let's touch on real-world importance of consolidation. Why do we need this? Why does it matter? I'd like to keep asking that for each of these episodes, because the more you understand why you're doing something for the accounting standards and not just following some rules, the more you will be able to apply your knowledge to a specific circumstance or scenario or situation. So the first reason here is, of course, investor decisions. Investors rely on group financials to assess company performance. If consolidation isn't done correctly, they might be misled. The second reason is regulatory compliance. There are accounting standards, of course, and they are there for a reason. IFRS and other standards require accurate consolidation. Failing to eliminate intragroup transactions can lead to regulatory issues which could result in fines, etc. Thirdly, in mergers and acquisitions, when companies acquire others, we need accurate fair valuation and reporting. And consolidation contributes to that, especially when we are looking at buying a group of companies. A great example of not following these rules properly is the collapse of Enron, which cites poor consolidation practices playing a major role in hiding financial issues from investors. That's how they were able to do it. So before we end off this episode, I'd like to address some common questions that students have with regards to consolidation. The first question that I have here is, do we always have to calculate goodwill? And the short answer to that is yes, especially if there's an acquisition. If there's no goodwill, you can check for a negative goodwill, which would mean that there's a bargain purchase gain somewhere. The second question, what happens if a subsidiary makes a loss? So the answer there is the loss is consolidated, and if there is non-controlling interest in the subsidiary, of course then a part of that loss is allocated to the non-controlling interest. So the third and last question, how do we treat foreign subsidiaries? Exchange rates come into play here, but it's really not a lot different to how you would treat local subsidiaries. Assets and liabilities are translated at the closing rate, income at the average rate, and exchange differences go to reserves. That's the extra step that you have to perform in order to be able to consolidate foreign subsidiaries into the consolidated account. Yeah, so that is it for me today. I'm your host, MJ the Tutor. Thank you for joining me today, and I hope you've enjoyed this episode. I'll see you again next time. Hopefully, we will still be keeping to the topic of consolidation of accounts. If you found this helpful, please be sure to subscribe or follow to catch the release of the next episode. You can also connect with me on various social media like Facebook, Instagram, X, Threads, BlueSky, YouTube. We have a lot more now under the handle at MJ the Tutor. You can also visit my website www.mjthetutor.com. Till next time, ciao for now!